China grew at the slowest rate since the financial crisis in Q1. Does this mean China is headed for a hard landing? I caught up with Carl Weinberg, founder and chief economist of High Frequency Economics, at an Introduction Capital event in Toronto. He says this doesn't necessarily mean it is a hard landing, let alone a landing at all. A self-proclaimed raging bull on China, I asked him about his outlook for the Chinese economy.
I don't think there has to necessarily be a landing in China at all. There may be a soft patch, but the core news for China has really been quite good over the last quarter. The most important element in their economic outlook has been the slowdown of food prices. Food prices affect people in China the way gasoline prices affect people here in Canada. When gas prices go up, people have less money to spend on other things. In China, when food prices go up, and they've been rising at a 14% yearly rate until very recently, it reduces their income. In the last 6 months, those food price increases have slowed, and with that slowing comes a boost to real disposable income. I think China's not going to have any kind of a landing at all. I'm looking for a good year in 2012 for China.
Do we need additional stimulus in China for you to be correct?
I don't think so. The drop in food prices is a substantial economic stimulus. It's huge. It's equal to several percentage points of GDP. I don't think they need any more than that in order to be able to move forward.
And what about hard assets? A lot of talk about a hard asset bubble in China. Is there one?
Well, you know, when you say hard assets, I guess you're talking about real estate.
Yes.
And those sorts of things. You know, real estate is important to a lot of people, but there are 1.3 billion people in China, and most of them are not affected at all by real estate. I think that in some areas we've seen some increases in real estate prices that aren't sustainable, and the people who've invested in those properties will be hurt. But is that big enough to derail the entire economy? I don't think so. Most of China's people don't own a property, will never own a property, will never have a mortgage, will never have a home equity line of credit, will never have any credit line whatsoever. So I think that while some people will lose money in a renormalization of the few asset prices that are too high, I don't think it's a crisis of national proportion.
So you're obviously very constructive on China. Do you have any concerns about China?
I do. I mean, China's bumping up against the food problem. I mean, this has been the big problem for the last 2 years. We had a bad harvest 2 years ago, and that drove up food prices and that depressed consumer spending. That could happen again. In fact, it almost certainly will in a nation that's trying to feed 20% of the world's population with only 10% of the world's arable land. So food is going to be a constraint for China. Energy is going to be a constraint for China. It will start to run out of coal in another decade or so. But these are all longer-term issues. The core process that China is experiencing is modernization. It's moving people off the farm into the cities. And every time they do, every person who moves produces between 4 and 14 times more when they get to the city than they did on the farm. And that alone is enough to generate double-digit economic growth. 700 million people left. They can keep on moving people for a long time.
New leadership in China next year. Does anything change?
I think the thing to think of is gradualism. I think things will change, but we're not going to see the boat rocked. Remember, everybody is saying China's slowed, economic growth is subpar, but we're looking still at an economy that's averaged 9.8% GDP growth over the last 33 years. That's an enormous accomplishment. And I think that the first rule of Chinese politics is that if it ain't broke, you don't have to fix it.
So when they talked about 7.5% growth a couple of months ago on a go-forward basis, are they lowballing the street?
They're lowballing everybody. This was not a forecast. This was a political declaration. Political declarations are designed to make politicians look good. So if you forecast 7.5 and you deliver 10, then you're more of a hero than if you forecast 8 and deliver 10.
So what do you believe the growth rate will be for the next couple of years?
My forecast, 9.8% GDP growth, give or take 9.8% every year for the foreseeable future.
Now, if we shift westward to Europe for a moment, what's going to happen with Europe?
Europe has a really severe problem. They have a banking crisis that's just beginning to manifest itself on the economy. The consequence of that for normal people is a credit crunch. We're seeing credit to the non-bank private sector contracting already, and that's going to get worse as banks try to re-stabilize their finances by a June deadline that's imposed by the governments. My outlook for Europe in the near term is an economic contraction on the order of magnitude of a depression, perhaps a double-digit contraction of GDP, with record high unemployment rates, with deflation, all caused by a contraction of bank lending that will squeeze the life out of the economy.
So, but will Europe stay together?
I think Europe will stay together. Nobody has an incentive to leave. As bad as things are in Euroland, they would be worse for individual countries trying to go on their own. The currency consequences, the financial consequences of being standalone, all add up to a rather grim prospect for a country leaving Euroland. I think they'll keep it together.
So what does that imply for the rate of corporate profit growth globally over the next few years and economic growth in general? Should investors expect low numbers?
You know, my message to investors is this. Europe is not the whole world. Europe is only 20% of world GDP. North America is 20% of world GDP. Economic growth is okay over here. Not great, but it's okay. Asia ex-Japan is 20% of world GDP. Those economies are booming, including China. Latin America, 15% of GDP. So we have a lot of places of the world that are growing. We have an engine with many cylinders. And if one cylinder stops working, that doesn't mean you have to predict that the entire engine's going to stop turning. You just want to bet more on the other cylinders.
And what about Canada? And what about the Canadian dollar versus the U.S. dollar? Above par, below par, looking forward?
I think the Canadian dollar continues to appreciate. And I think that is driven to some extent by the crisis in Europe. If you're sitting in Europe and you're looking at a banking sector at risk and an economy that's contracting, at public sector finances that are dodgy at best, because the cost of repairing all these countries still has to be added to the ongoing fiscal deficits to see what it's going to look like. And you compare that to Canada, we have very, very stable public sector finances, the best in all the world. You have a very, very stable banking sector. It's a very attractive proposition. And you have growth to boot. And you have resources to boot. So I think Canada should be an attractive proposition for investors. I think the loonie will continue to appreciate it because people will come here for safe haven.
That was Carl Weinberg, chief economist of High Frequency Economics. There was definitely some very interesting factoids that he tabled to us in that conversation. Catherine, what's your view on China?
Well, I want to step back for 1 second because I think that when we talk about the market volatility on a daily basis, which, you know, is warranted, I think that what Carl points out is very important, is that as much as the markets are interconnected, you can also find opportunities because they aren't all connected. And I think that that's one of the items that we've got to really take away and focus in on because there are opportunities. I mean, that's why, again, I want to point out some of these stock specifics that continue to do well. But that's my take on what he's saying.
9.8%, that's very, very high for a very long time, he said, in the foreseeable future. And then he went on, that was the one thing I would have asked more. So Europe, credit crunch, he said, depression in Europe. But China, Europe is a big market for Chinese goods.
50% of Chinese exports go to Europe.
So this is a bit questionable. 9.8, I'll take 7%. 7% for me growth in China would be great too. Doesn't need to be 9.8. But 9.8 seems to me a little high. Right. I think markets should not sell off if it's less than 9.8. Right?
Again, I think it's the quality of the growth too. It's great to see retail sales driving the economy as opposed to building more buildings.
Oh, that's right. We'd love to see domestic demand grow over there, and then the culture shifting, and then it's a sheer numbers thing in China because of the population. And another thing that struck me in the interview was the Canadian dollar will continue to appreciate against the U.S. dollar. Who is the #1 holder of U.S. Treasuries? What happens if there is another QE? What happens to the U.S. dollar? Canadian dollar above par means U.S. dollar weakens. How is the decline in the U.S. dollar going to affect the #1 holder of U.S. Treasuries?
Well, Carl said to me that he does not think the Chinese have any interest in sitting at the table and striking a deal with the Americans whereby they revalue those two currencies. I thought it made sense because it would cut the debt levels of the U.S. and it would decrease inflationary pressures in China, but he says they've got no interest, not only in not doing that, he doesn't think they'll float their currency.
It's a precarious relationship between China and the U.S. in the sense that every time China would like to do something, they just diversify or say they diversify into the European.
But going back to China and growth, which is what you started the conversation with saying, Andrew, you know, you have to look at it as well from a shift that's going on in terms of the population. And do we get too caught up in all of these data points because there's a larger secular shift going on that we should maybe be paying more attention to as opposed to moving back and forth on the data points?
Well, I think the market gets excited and disappointed at, you know, daily, weekly, monthly data.
Right.
Bottom line is the economy is going to continue to grow at 7 to 10% for the next several years. Lots of growth there.
Okay, fair enough. Up next, we answer your questions on the markets. You can email us at marketsense@bnn.ca, or you can tweet us at marketsense BNN.